Hello everyone. The biggest difference between a consistently profitable trader and a struggling trader isn't their strategy, it's their habits. Because successful traders don't rely on making the right decision every single time. They've trained themselves to make good decisions automatically. That's what allows them to trade with discipline and consistency, day after day, while most traders keep falling into the same mistakes again and again. I'm Priya and welcome back to your channel. Today we are diving into lesson 37 from the Daily Trading Coach, written by Steenbarger. In this lesson we'll explore how to build trading habits that make better decisions, feel natural, reduce costly mistakes, and help consistency become a part of who you are as a trader. Friends, rules act as the bridge between our intentions and our habits. Think about it. Children aren't born disciplined or responsible. Those qualities are taught over time. Parents and teachers introduce simple rules, and through repetition, those rules gradually become part of a child's behavior. Sometimes we learn by observing role models, and sometimes we build new behaviors by mentally rehearsing them again and again until they become second nature. The same process applies to trading. Imagine a trader who is learning how to control losses. He doesn't wait for a losing position to become so painful that fear forces him out of the trade. Instead, he creates a rule in advance. He tells himself, if price reaches this level, I will exit the trade. At that moment, the decision is no longer being made by emotion. It's being made by a rule. He reminds himself that breaking the rule could allow the loss to grow even larger. But following the rule is what protects him over the long run. And that mindset is what separates an average trader from a disciplined one. Let's look at a simple example. Imagine you're running late for work. You're in a hurry, and traffic is backed up everywhere. Even then, you don't start driving on the wrong side of the road. Why? Because you understand that saving a few minutes isn't worth the risk. It could harm you, and it could harm others as well. So instead of reacting to the pressure of the moment, you follow the rules. Trading works the same way. When money is on the line, emotions like fear, greed and frustration can take over very quickly. Fear says, get out now. Greed says, stay in a little longer. But when every decision is driven by emotion, mistakes become almost inevitable. These are the moments when traders abandon their rules and end up repeating the same costly errors over and over again. That's why successful trading is built on more than just a good strategy. It's built on a set of rules that help you make sound decisions even when emotions are running high. Because in the end, successful traders don't follow their emotions. They follow their rules. Friends, every day we make countless decisions without even thinking about them. Waiting in line, stopping at a red light, or speaking politely to other people. We don't consciously analyze these actions every single time. We do them because they've become deeply ingrained habits. Through repetition, they've become part of who we are. And in trading, that should be the goal as well. Your rules should become so well established that making the right decision no longer feels like a constant mental battle. But this is where a major challenge appears: human nature. Imagine the market has been moving higher for the past month. It was up all last week, and today it's showing strength again. In that situation, most people naturally feel that buying is the obvious choice. On the other hand, if the market has been falling day after day, most traders will feel more comfortable selling. The problem isn't recognizing the trend. The problem begins when we make decisions simply because everyone else is making the same decision. Some of the most expensive mistakes in trading happen when traders follow the crowd without a clear set of rules or a defined system. Remember, just because something looks obvious to everyone today doesn't mean it will remain that way tomorrow. The trend may continue, but the market could also reverse direction without warning. That's why identifying a trend is only one piece of the puzzle. You also need a clear trading plan, well-defined entry and exit rules, and strong risk management. Most traders buy when excitement is at its peak and sell when fear is at its strongest. That's where losses often begin, because the decision is no longer being driven by analysis. It's being driven by emotion and crowd psychology. Successful trading isn't simply about following the trend. It's about following the trend through the lens of your rules, your system, and your discipline. And that habit is what lays the foundation for long-term consistency and profitability. Friends, the biggest challenge in trading isn't knowing what to do. The real challenge is being able to do the right thing at the right time. Because when money is on the line, emotions often become louder than logic. Sometimes fear keeps us from taking a valid trade, and sometimes greed pushes us to take risks we shouldn't be taking. As a result, we end up making decisions that we later regret. This is where strong trading rules become incredibly valuable. They act as a protective barrier between us and our emotions, like a brake pedal, preventing us from making impulsive decisions in the heat of the moment. For example, imagine you have a simple rule. I will not take a trade unless the market meets all of my predefined conditions. Or, I will only enter a trade if the reward to risk ratio is at least 2 to 1. Now it doesn't matter how attractive the market looks, or how many people around you are shouting buy now, you remain calm, because the decision isn't being made by your emotions, it's being made by your system. And that is one of the defining characteristics of a professional trader. You'll often hear traders say, the setup was there, but I couldn't pull the trigger, or I lost money on the previous trade, so I was too afraid to enter this one. In most cases, the problem isn't the setup itself. The problem is that their rules exist only in their minds. They were never written down, never practiced, and never reinforced enough to hold up under pressure. So what does a strong setup rule look like? First, its criteria are crystal clear. There's no confusion about when to enter a trade and when to stay out. Second, it is mentally rehearsed over and over again. So when the opportunity appears in a live market, the action feels natural rather than stressful. And third, the rule is non-negotiable, meaning if all the conditions are not met, there is no trade. Simple as that. Remember, a setup is more than just a trading signal. It's a commitment to your discipline. And over time, that commitment is what creates consistency. Because traders with weak rules usually have weak consistency. Their decisions change with every new market condition, every recent win, and every recent loss. But traders who follow clear and structured rules gradually develop a process they can trust. A process that remains stable regardless of what the market is doing. And in the end, consistency does not come from strategy alone. Consistency comes from routine. Routine comes from discipline. And discipline is built through strong rules, repeated again and again, until they become habits. So today, ask yourself one important question. Are your trading rules simply ideas that exist in your head, or have they become a genuine part of the way you trade every day? Friends, on the surface, trading rules may seem like nothing more than a few lines written on paper. But for a successful trader, they are much more than words. They are a source of trust. They are a source of discipline. And in many cases, they are the trader's greatest form of protection. When you become your own coach, simply writing down a set of rules is not enough. You have to strengthen those rules to the point where you can follow them even under the most difficult circumstances. And that is where the real challenge begins. A good rule is not just an idea that exists in your mind. It carries emotional significance as well. Think about it. A person with diabetes can sit in front of a dessert and still choose not to eat it. A student who knows the answer may still wait patiently for their turn to speak. Why? Not simply because they remember the rules, but because they understand the consequences of breaking them. The same principle applies to trading. If you create a rule, but deep down you're telling yourself, maybe I'll make an exception this time, that rule will never truly protect you. Because in that moment, your emotions will be stronger than your commitment. That's why whenever you create a trading rule, whether it relates to entries, exits, stop losses, or position sizing, don't just write it down and move on. Internalize it. Connect with it. Remember the times when you broke that rule and paid the price for it. Then think about the trades where you stayed disciplined, where you followed your process from start to finish, and regardless of the outcome, you were able to make decisions with confidence and peace of mind. Remember, a rule should be more than a guideline. It should become a conviction. You should feel, deep down, I must follow this. Not, let's see what happens this time. And now, there's a responsibility that falls on you. Take a few minutes and ask yourself some honest questions. Do I truly have clear trading rules? Or do I simply have a collection of vague ideas that I remember from time to time? Do I regularly rehearse and reinforce my rules? Or did I write them down once and then forget about them? If you're like most traders, there's a good chance you have principles, but not firm rules. And that gap is often the root cause of inconsistent performance. Your most important rules should be the ones that consistently show up in your best trades, the patterns, the behaviors, and the decisions that form the foundation of your success. Because rules are not only there to tell you what not to do, they also remind you what your best trading practices look like, and help guide you back to them again and again. Friends, always remember one thing: you cannot follow a discipline that you have never clearly defined. If your trading rules are not clear and specific, how can you expect yourself to follow them consistently? The clearer your rules are, and the more deeply you believe in them, the easier it becomes to avoid impulsive decisions, and the more effectively those rules will guide you back to your best trading behavior. Many people think rules are restrictive, but the truth is exactly the opposite. Rules create freedom. They give you the freedom to stay focused. They give you the ability to remain consistent. And most importantly, they teach you to trust your process instead of your emotions. Think about it. When a pilot safely lands an aircraft, when a surgeon performs a complex operation, or when a race car driver makes split-second decisions at high speed, do they rely on guesswork? Absolutely not. They rely on their training, their process, and their rules. Because they understand that even a small mistake can be extremely costly. Trading is no different. Consistency is born when your rules become so deeply ingrained that taking the right action no longer feels like a struggle. When decisions come not just from conscious thought, but from habit. And that is the true purpose of self-coaching: to build habits, to create rules that eventually become second nature, so that outstanding performance is no longer something occasional, but becomes your new normal. Remember, rules are not meant to be written and forgotten, they are meant to be lived. And the trader who learns to live by their rules gradually begins to think and perform like a professional. Up to this point, we've explored why rules matter, how they protect us from emotional decision making, and how they create the foundation for long-term consistency. But now another important question emerges. Am I truly following the rules I've created, or am I simply assuming that I am? This is where the next important concept begins: self-evaluation. When you start creating a daily or weekly report card based on your trading rules, your perspective begins to change. Your focus shifts away from how much money you made and moves toward the quality of the decisions you made. And that shift is where real growth begins. Friends, so the question is, if we want to track our trading rules, what exactly should we be measuring? Dr. Brett suggests that every trader should create a personal report card. But this report card shouldn't be based on profits and losses. It should be based on discipline, because profits can fluctuate from day to day. But when your discipline is strong, your results tend to become stronger over the long run as well. For example, start with position sizing. Many traders perform solid analysis, but then risk far too much on a single trade, and one bad trade ends up ruining an entire week. So ask yourself, did I size my position according to my risk management plan, or did I take on more risk than I should have? Next comes loss management. When your stop loss was hit, did you accept the loss and move on, or did you move the stop and hope the market would come back? This is where real discipline is tested. Then there's the issue of adding to positions. Sometimes a trade moves in our favor, and we increase our position without any clear plan. Other times, a trade moves against us, and we start averaging down. But the important question is, was that decision part of your trading plan, or was it driven by emotion? Another critical rule involves knowing when to stop trading. Imagine you've had 3 or 4 losing trades in a row. Did you take a break and regroup, or did you start taking more trades in an attempt to win the money back? This is where many trading accounts suffer their greatest damage. Then comes risk expansion. Many traders have a couple of successful trades and suddenly begin to feel invincible. They increase their position size dramatically, only to give back their gains shortly afterward. Professionals, on the other hand, increase risk only when strong performance has been demonstrated consistently over time. Entry and exit rules are equally important. Did you take a trade because it matched your system, or did you jump in simply because the market was moving quickly? And what about your exit? it? Did you follow your plan, or did fear and greed make the decision for you? Friends, preparation is also a rule. What did you do before the market opened? Did you review your charts, mark key levels, analyze the broader market context? Or did you begin trading the moment the opening bell rang? And finally, there's diversification. Was all of your risk concentrated in a single sector, a single theme, or a single idea? Or did you spread your risk intelligently? Now here's something important to remember. Not every trader needs the exact same set of rules, but every trader does need their best rules. The rules that consistently appear in their most successful trades. The habits, the decisions, and the behaviors that contribute to their strongest performance. So before checking your profit and loss at the end of the day, take a look at your discipline report card first. Because every trader tracks money, but the trader who starts tracking discipline begins the journey toward becoming a true professional. And that is perhaps the most important lesson of all. Consistency does not come from one great trade. Consistency comes from hundreds of small decisions made correctly over time. And those decisions begin with clear rules. Your rules are your coach, your protection, and the foundation upon which your trading growth is built.